Imagine the future of quantum computing colliding head-on with, well, today's recession fears.
Yeah, it's like a classic unstoppable force meeting an immovable object.
Exactly. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks.
Glad to be digging in.
Today, we're taking a deep dive into IonQ, ticker IonQ. We're using our research data captured on September 2, 2025.
And our mission really is to unpack this fascinating conflict for you.
We hope you navigate these, well, turbulent waters.
It's definitely a nuanced time for a company like IonQ. I mean, the long-term promise is huge, undeniable even.
But the immediate market environment, that presents some unique challenges.
For sure.
Absolutely. So let's start with that formidable, immovable object, the broader macroeconomic picture.
Okay.
This morning, pre-market futures are painting a really cautious picture. The tech-heavy NASDAQ, it's already sliding down nearly a full percent.
Oof.
It certainly feels like a storm is gathering, doesn't it?
It's more than just a feeling, unfortunately. We're seeing economists from Moody's, Barclays. They're now putting the odds of a U.S. recession by year-end at, well, basically a coin flip. 50-50.
50-50. Wow.
Yeah, they're using phrases like stall speed. Essentially saying the economy is moving so slowly, it's really at risk of a downturn.
That sounds vulnerable.
It is. Plus, we've got a packed schedule of economic data coming out today. Key manufacturing reports, things like that.
Adding to the uncertainty.
Exactly. It just adds to the market's cautious mood. And these broad economic shifts, well, you can imagine, they create significant headwinds, even for really groundbreaking companies.
That's a powerful headwind, no doubt. So how is IonQ, this company, literally building tomorrow? How are they reacting to these very real present-day economic jitters? This is our unstoppable force.
Right.
IonQ is, truly at the cutting edge, building and selling access to quantum computers. And their fundamental story.
It's pretty compelling, actually. They just delivered a really strong Q2 report.
Yep.
$20.7 million in revenue. That smashed their guidance by a solid 15%.
15%, okay. That's significant.
It is. And they're not just sitting still. They're expanding globally. New partnerships popping up in South Korea, Japan, Sweden, Australia, too.
So strong performance, global reach. What are the analysts saying?
Well, another interesting angle here is Wall Street. Analysts are overwhelmingly bullish on this quantum pioneer. We're talking 75% rating the stock a buy or strong buy.
75%.
And that sentiment's only been getting stronger recently. But, and this is the big but.
Uh-oh. Here comes the conflict.
Exactly. Here's where the unstoppable force hits that immovable problem. Traditional valuation models are just, well, flashing bright red.
How red are we talking?
One analysis we saw pegs IonQ's fair value at a staggering negative $35 per share.
Negative 35. Compared to its current price near, what, $43?
Precisely. A universe away.
Yeah.
So this raises a really important question for you, the investor.
Yeah.
How do you weigh investing in that future potential versus the current financial metrics?
Especially for a growth story that's, burning cash to build the future, not turning a profit just yet.
Right. It's the classic growth versus value dilemma, but amplified.
That's a huge dilemma. It gives you pause. But can traditional valuation models even capture the potential of quantum computing? Or is it like trying to fit a square peg in a round hole?
That's exactly the heart of the conflict. For a pre-profit, high-growth, paradigm-shifting stock like this, macroeconomic fear, it doesn't just create headwinds.
It does more.
It can completely decouple the short-term price action from its fundamental long-term promise. It makes today's market less about underlying value and, frankly, more about immediate sentiment and fear.
Fascinating. Okay, so let's look at that sentiment then and the stock's technical behavior. What's the market actually betting on?
Well, in the options market, the sentiment leans somewhat optimistic. The put-to-call ratio is 0.8.
Okay, 0.8. So for every 10 calls, there are 8 puts, meaning more bullish bets than bearish ones.
Correct. It signals more optimism than pessimism, relatively speaking. Bulls seem to be targeting the $45 call strike price.
And the bears.
They're keeping a close eye on the $40 put strike. That seems to be their line in the sand.
Okay, so options lean optimistic. But is that the whole picture?
Not quite. While the options market shows one side, we also see a kind of counter-narrative when we look at short interest.
The percentage of shares borrowed and sold short.
Exactly. It stands at nearly 14% of the float.
14%? That's pretty significant.
It is. That's a meaningful number of investors actively betting against the stock. hoping to buy it back cheaper later.
So it reveals a deeper layer of skepticism, really contrasting with that options market optimism.
Basically,
Yeah.
despite that skepticism, when you look at the technicals, the actual price action itself, it shows renewed strength.
Oh, really? How so?
We're seeing a clearly bullish trend still in place. Strong buying pressure, which suggests accumulation big players might be buying in. And momentum is accelerating. What's also kind of intriguing is that volatility is calming down a bit.
Calming volatility. What does that usually suggest?
Well, the daily price swings are shrinking. That often suggests the stock is consolidating its recent gains, maybe building energy for its next significant move.
Interesting. So you've got this landscape of mixed investor bets, optimistic options, significant shorts, but strong underlying stock behavior.
Right. Navigating that requires a nuanced approach, which brings us to our playbook for today.
All right, let's bring it all together. What does this mean for today's playbook? After synthesizing all our research, what's the verdict?
Our verdict today is a neutral stance.
Neutral. Okay, why neutral given some of the strong company points?
The why is crucial here. It's because we have this massive conflict, right? On one side, IonQ's fantastic company-specific news, that revenue beat the global expansion.
Backed by bullish analysts, optimistic options data, a stellar technical picture.
Exactly. But on the other side, you have these powerful macro headwinds. Serious recession fears, a broad market slide happening right now.
So it's too risky to pick a side just yet.
Pretty much. Today's market for this stock isn't about blindly picking a side. It's about seeing which force the quantum promise or the macroeconomic storm actually bends first.
Okay, so what are the key levels investors should watch today then?
All right, for the bulls, you want to see the stock hold above its pre-market low. That's around $41.80. And ideally, push above the pre-market high of $43.10.
Got it. Hold $41.80, break $43.10 for the bulls and for the bears.
The bears are watching for a break below that major options level we mentioned, the $40 mark. A move below there could signal trouble.
So today, you're really just observing a true test of strength. It's the company building the future versus an economy grappling with the present.
That sums it up perfectly.
That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Always do your own research or consult with a qualified financial advisor before making any investment decisions. Thanks for tuning in, and we'll catch you on the next episode of De-Risk.